In the realm of business, few terms captivate the imagination like unicorn. The term, borrowed from the mythical creature, signifies a startup company valued at over $1 billion. These companies are rare, much like the unicorns of legend, and they evoke a sense of wonder and possibility. It conjures images of rarity, magic, and immense value. The allure of unicorns lies in their potential to disrupt industries, create new markets, and generate enormous wealth for their founders and investors. They are the epitome of innovation and ambition, often led by visionary entrepreneurs who dare to dream big. But what happens when the mythical creature of the business world becomes too common? When the market is flooded with companies claiming unicorn status, the very essence of what makes them special begins to erode. The term unicorn loses its luster, and the market starts to question the true value of these companies. When valuations soar to dizzying heights, fueled by hype and speculation, the risk of a bubble becomes very real. Investors, driven by fear of missing out, pour money into these startups, often without a thorough understanding of their business models or long-term viability. This speculative frenzy can inflate valuations to unsustainable levels. The result can be a dangerous bubble, poised to burst and leave a trail of disillusionment and financial ruin in its wake. When the bubble bursts, it can have far-reaching consequences, not just for the companies involved, but for the entire market. Investors lose money, employees lose jobs, and the broader economy can suffer. This essay delves into the world of overvalued unicorns, those startups that have achieved billion-dollar valuations, often prematurely. These companies, while promising on the surface, may lack the solid foundations needed to sustain their growth. They become overvalued due to a combination of market hype, aggressive marketing, and sometimes unrealistic projections. We'll explore the factors that contribute to these inflated valuations, such as the role of venture capital, the influence of media hype, and the pressure on startups to scale rapidly. We'll also examine historical examples of unicorn bubbles bursting, such as the dot-com bubble of the late 1990s and the more recent WeWork debacle. Fasten your seatbelts as we journey through the exhilarating and sometimes treacherous landscape of unicorn startups. We'll navigate the highs and lows, the successes and failures, and the lessons learned along the way. This journey will provide valuable insights for entrepreneurs, investors, and anyone interested in the dynamics of the startup ecosystem. The ride might be bumpy, but it's also filled with opportunities for those who are prepared. By understanding the factors that drive unicorn valuations and the risks involved, we can make more informed decisions and avoid the pitfalls that have ensnared so many before us. So, let's embark on this journey together and uncover the true allure of unicorns in the business world. The term unicorn, coined in 2013 by venture capitalist Aileen Lee, refers to a privately held startup company with a valuation of over $1 billion. These companies, often characterized by rapid growth and disruptive technologies, are the darlings of the tech industry, attracting massive investments and generating significant media buzz. Unicorns represent the pinnacle of startup success, promising investors extraordinary returns and capturing the public's imagination with their innovative products and services. However, the allure of striking it rich can sometimes overshadow the fundamental principles of sound business practices and realistic valuations. Pets.com, an online retailer of pet supplies, was launched in the late 1990s during the height of the dot-com boom. The company aimed to revolutionize the way pet owners shopped for their furry friends by offering a wide range of products online, from pet food to toys and accessories. However, Pets.com quickly became a poster child for the excesses of the dot-com bubble. Despite generating meager revenue, the company attracted significant attention from investors who were eager to capitalize on the burgeoning internet economy. Pets.com faced stiff competition from established brick-and-mortar stores that had loyal customer bases and well-established supply chains. These traditional retailers were not only experienced, but also had the advantage of physical presence, which many customers still preferred. In a bid to outpace its competitors, Pets.com went public in the year 2000 with a valuation of over $82 million. This move was part of a broader trend where tech companies were rushing to the stock market, often with inflated valuations that were not supported by their financial performance. Fueled by aggressive marketing campaigns, including a memorable Super Bowl commercial featuring a sock puppet mascot, Pets.com aimed to build brand recognition and attract a large customer base quickly. The commercial was catchy and generated a lot of buzz, but it came at a high cost. Despite the initial excitement, Pets.com burned through cash at an alarming rate. The company's business model, which relied heavily on offering deep discounts and free shipping to attract customers, proved to be financially unsustainable. The strategy of providing significant discounts and free shipping was intended to undercut competitors and gain market share rapidly. However, this approach led to substantial financial losses, as the cost of fulfilling orders often exceeded the revenue generated from sales. As financial troubles mounted, it became clear that Pets.com could not sustain its operations. The company shut down in 2000, just 9 months after its initial public offering. This rapid decline was a stark contrast to the high hopes and lofty valuations that had characterized its early days. The short-lived IPO of Pets.com serves as a cautionary tale about the perils of overvaluation and the importance of a sustainable business model. Investors who had poured money into the company saw their investments evaporate almost overnight. Pets.com's rise and fall highlight the dangers of hype and overvaluation, especially in a rapidly evolving market like the internet economy. The company's story is a reminder that while innovation and ambition are crucial, they must be grounded in sound financial planning and realistic expectations. The dot-com bubble burst left many companies in ruins, but the lessons learned from Pets.com's failure continue to resonate in the tech industry today. Entrepreneurs and investors alike are reminded to balance enthusiasm with caution, ensuring that their ventures are built on solid foundations rather than fleeting trends. Pause threes. As we turn our attention to the present day, we find that the allure of unicorns continues to captivate investors and the public alike. However, several recent unicorn IPOs have underperformed, offering valuable lessons in the complexities of going public. Pause twos. Take Coinbase, Coin for example. As a leading cryptocurrency exchange, Coinbase's fortunes are deeply intertwined with the volatile crypto market. The recent downturn in cryptocurrency prices has significantly impacted Coinbase's revenue and profitability. Adding to the uncertainty, regulatory scrutiny surrounding the crypto industry has left investors wary, leading to a notable decline in its share price. Pause threes. Another case is Sweetgreen, SG, the fast casual salad chain that went public in late 2021. Despite its initial excitement, Sweetgreen's shares have struggled due to concerns about its high valuation and uncertain path to profitability. Rising labor costs, supply chain issues, and mounting competition in the healthy food space have further compounded its challenges. Pause threes. Rent the Runway, Rent, an online clothing rental company, has also faced significant hurdles. The post-pandemic shift in consumer behavior has led to a decline in demand for rental clothing as people return to offices and social events. Additionally, concerns about its business model and profitability have weighed heavily on its stock price. Pause twos. These examples highlight several common reasons for the struggles of recent unicorn IPOs. Pause twos. Overvaluation. Many unicorns enter the public markets with high valuations based on their private funding rounds. These valuations may not be sustainable in the public market, leading to a decline in share prices. Pause twos. Market volatility. Economic downturns, interest rate hikes, and geopolitical events can create volatility in the stock market, impacting the performance of newly public companies. Pause twos. Increased competition. Unicorns often operate in highly competitive industries, facing both established players and new entrants, making it challenging to maintain market share and achieve profitability. Pause twos. Changing consumer behavior. The COVID-19 pandemic has led to significant shifts in consumer behavior, which can impact the growth prospects of some businesses. Pause twos. Regulatory scrutiny. Increased regulatory scrutiny in certain industries, such as cryptocurrency and online trading, can create uncertainty and hinder the growth of companies operating in those spaces. Pause threes. These current examples serve as a reminder that the journey from unicorn to successful public company is fraught with challenges. While the allure of unicorns remains strong, it is crucial to approach these investments with a blend of optimism and caution, grounded in thorough research and realistic expectations. Pause twos. Understanding these dynamics can help investors navigate the complexities of the market and make more informed decisions, ensuring that the lessons of the past are not forgotten. The history of business is littered with cautionary tales of bubbles inflating and bursting, leaving investors nursing heavy losses and markets reeling from the fallout. These financial bubbles, often driven by a mix of speculation, greed, and a lack of due diligence, have a way of captivating the market's imagination. Investors, both seasoned and novice, get swept up in the euphoria, believing that the rapid rise in asset prices will continue indefinitely. But as history has shown us time and again, what goes up must come down. The dot-com bubble of the late 1990s and early 2000s serves as a stark reminder of the dangers of irrational exuberance and overvaluation. This period was marked by a frenzy of investment in internet-based companies, many of which had no proven track record or sustainable business model. The Nasdaq Composite Index, a benchmark for tech stocks, soared to unprecedented heights, fueled by the belief that the internet would revolutionize business and society. While this belief was not entirely misplaced, the valuations placed on many of these companies were far from justified. During this period, internet-based companies with little to no revenue and often questionable business models attracted billions in investment capital. Venture capitalists and individual investors alike poured money into startups, hoping to find the next big thing. Companies with catchy names and ambitious promises saw their stock prices skyrocket, even if they had yet to turn a profit. The market was driven by a fear of missing out, with investors scrambling to get a piece of the action before it was too late. Valuations skyrocketed, driven by speculation and the fear of missing out. The media played a significant role in fueling this frenzy, with headlines touting the latest internet sensation and analysts predicting endless growth. The hype was palpable, and it seemed as though everyone wanted to be part of the internet revolution. However, beneath the surface, many of these companies were struggling to find a viable path to profitability. The disconnect between their stock prices and their actual business performance grew wider by the day. However, the bubble eventually burst, exposing the unsustainable nature of many of these businesses and leading to a painful market correction. The Nasdaq Composite Index plummeted, wiping out trillions of dollars in market value. Investors who had bought into the hype found themselves facing significant losses, and many internet startups went bankrupt. The aftermath of the dot-com bubble served as a harsh lesson in the dangers of speculative investing and the importance of due diligence. It also highlighted the need for a more measured approach to valuing companies, one that takes into account their actual business fundamentals, rather than just their potential for growth. The dot-com bubble was not the first, nor will it be the last, financial bubble to capture the market's imagination. From the tulip mania of the 17th century to the housing bubble of the early 21st century, history is replete with examples of speculative excess. Each bubble follows a similar pattern: rapid price increases, widespread euphoria, and an eventual crash. While the specifics may differ, the underlying dynamics remain the same. Investors, driven by a mix of greed and fear, push asset prices to unsustainable levels, only to see them come crashing down when reality sets in. Understanding the history of financial bubbles can provide valuable insights for today's investors. By studying past bubbles, we can learn to recognize the warning signs of speculative excess and take steps to protect ourselves from the inevitable crash. This includes conducting thorough due diligence, maintaining a diversified portfolio, and avoiding the temptation to chase after the latest hot investment. While it may be impossible to completely avoid the impact of financial bubbles, being aware of their dynamics can help us navigate the market more effectively and make more informed investment decisions. In conclusion, the story of the dot-com bubble serves as a powerful reminder of the dangers of irrational exuberance and the importance of sound investment principles. By learning from the past, we can better prepare for the future and avoid the pitfalls of speculative investing. Whether we are investing in tech startups, real estate, or any other asset class, it is crucial to remain grounded in reality and to base our decisions on solid fundamentals rather than hype and speculation. Only then can we hope to achieve long-term financial success and avoid the painful consequences of a bursting bubble. So, the next time you hear about the latest investment craze, take a moment to reflect on the lessons of the past. Remember that while the promise of quick riches can be enticing, it often comes with significant risks. By staying informed, conducting thorough research, and maintaining a disciplined approach to investing, we can navigate the market's ups and downs with greater confidence and resilience. After all, in the world of investing, slow and steady often wins the race.